The things you could do, bury it in a tin can in the backyard, for instance. But idle money may in time depreciate. Or you could spend it on a couple of nights out a week with the wife. This seems like a lot of fun. But with this kind of life, you'd depreciate. So why not put your money to work?
Put my money to work?
That's right, Mr. Finchley. You can own a share of American business. There are over 1,200 companies listed on the New York Stock Exchange. Companies which employ more than 11 million people, produce half of all the goods made in America, and pay about half
Hello, Ask the Compound here. We have an excellent show today. A guest you know and love. Thanks to everyone in the live chat on YouTube. Thanks to everyone watching live on Twitter, which is still a relatively new format for us. Lots of good questions today. We are going to answer questions on, will AI be useful in offering financial advice in the future? Are we due for a sell-off in 2025? Buy the election, sell the inauguration. How to factor in an inheritance into your financial plan. What to do with the proceeds from the sale of the house with stocks at all-time highs, and why don't more people use long-dated options in their portfolios? Duncan wants to use like zero-dated options in his portfolio.
I like that question.
All right, email us if you have a question. It's askthecompoundshow@gmail.com. Today's Ask the Compound is sponsored by our friends at Public. Go to public.com/ATC to check out Public's bond account. What is a bond account at Public, you might be asking yourself? Well, a bond account is a way to lock in your yield by buying individual bonds that are corporate and high yields. You can lock in rates of 6% or higher right now. Fed is cutting rates. Bond yields are not promised to anyone. They can move in a hurry. Listen, more rate cuts are coming. We don't know what's going on with the economy. Bond yields could slow. You can lock them in now. It only takes a couple of minutes to sign up at public.com. Remember, public.com/ATC. Brought to you by Public Investing. Member FINRA and SIPC. As of 9/26/24 for that 6% yield. That's the average annualized yield to worst across bond account, and it's greater than 6%. Yield to worst is not guaranteed. Not an investment recommendation. All investing involves risk. Visit public.com/disclosure/bond-account for more info. All right, Duncan, last week we had a question from someone who asked, is all the jewelry I'm buying my wife actually worth anything? Can we count it as an asset class? A bunch of people sent us this chart. John, throw it up here, chart on. This is the price of diamonds. Bank of America actually has a diamond price index. And this thing is in a severe bear market, which is kind of surprising. So I think it's down 50% from the 2022 highs. I'd say 60% or so from the 2011 highs. I don't know what happened if everyone in China decided to sell their diamonds. But so the guy last week, those gifts you're buying your wife as jewelry, that's a hobby, not an investment.
Or buy gold jewelry, not diamond jewelry. Right.
Good luck with that. All right, let's get into the questions.
Is there a diamond ETF? I'm guessing not. Right. I've never heard of that.
No, but if there was, you'd buy like the cubic zirconia 3 times leveraged.
No.
Come on. All right. First question.
Right. Up first, we have a question that came in from Twitter. Isn't AI the solution for a shortage of financial advisors?
All right, John, pull up my blog post here. I wrote about how we have $80 trillion of baby boomer wealth coming in. Do we have enough financial advisors to handle it, since so many of them are going to be retiring in the years ahead? So the next one, this was based off of my talk with Christine Benz on the Unlock. So if you're an advisor, sign up at advisorunlock.com to follow more. But basically, I was wondering, are we going to have enough? Because there's a ton of advice coming, and a lot of people said, wait a minute, what's that? Oh. Where did we get the sound effect from?
Thanks for having me over. Hey, Ben, why are we both dressed like Zelensky today? Good to be here.
Twinning.
All right. So, Josh, you're the perfect person to ask because you know more about the wealth management industry than anyone. I think I've heard you say something in the past like wealthy people won't want to work with robots. And so I heard this from dozens of people when I asked the question, do we have enough? Because what's the average age of a financial advisor in America? You know, this 60 or something? It's old.
Ancient for like most industries, or one of the oldest industries.
So I talked with Christine and I said, what's going to happen here? Are we going to have a shortage? And a lot of people said, no, don't worry about it. AI will take this. And I think AI is going to do a lot of good for people in offering advice. I also think that, TurboTax didn't mark the end of CPAs. So what say you on AI and financial advice in the years ahead?
I'm taking my wife to Mexico for 3 nights at the end of this month. I don't really do long vacations. I haven't been away for 7 days, maybe ever.
I liked your rule about that. You said when you didn't have as much money, you and your wife would go to nicer places just for shorter amounts of time, though.
Yeah.
I thought that was a good rule.
I can't disclose where I'm going until I leave, but
I thought you were a big hostel guy. You know?
Quiet now. I'm going to one of the illest resorts in Mexico, but like I don't want to spend like the amount that I could buy a car with. So we're going to go for a few nights, and we're leaving the teenagers home. My daughter is 18, my son is 15. They have a car, they have Uber Eats. It's an experiment. We'll see how it goes. I booked that trip with a human travel agent. I could have sat on Perplexity and Yelp and done all this stuff like with AI or whatever. I don't want to. And the amount that I'm spending and the relatively short length of the trip, I just want it planned right. I want to go to the best restaurants while I'm there. I want to have the right itinerary during the day. I want a cabana. I want all this stuff, and I don't want to putz around in an AI with a chatbot. Now, is there a future where I say to the chatbot, "Here are my dates. Book me flights." Yeah, maybe. It's not tomorrow. I think the answer to the question is 40% of financial advisors are expected to retire over the next decade, and 60% of RIA assets are currently managed by advisors 55 years and older. So that's really all you need to know. The opportunity for human advisors is massive, and we're going to use AI to be better at our jobs and be able to serve more clients. So yes, it's the answer, but not in the way that some people might think. Now, you will have a couple B2C AI, like have your money managed by AI.
Yeah, it'll make robo-advisors better, right?
Right. You'll have a few of those, but they're not going to work. And what you'll find when you dig into their ADV filings is they're going to be hiring tons of human advisors to actually be able to do that business as fiduciaries. So I think that AI tools are going to be huge for advisors. They're going to help us find clients. They're going to help us answer client questions more rapidly. They're going to help us schedule meetings. They're going to help us follow up after meetings. They're going to complete paperwork. I'm super pumped about the entrance of AI to the industry. I just don't think it's going to be like 80% of the population uses a human advisor and 20% just talks to robots all day. It's just hard for me to picture that being a satisfactory scenario for the consumers themselves.
I agree with you that it's going to make the right financial advisors who use AI way more efficient. Like our advisors are already salivating at the prospects of an AI that will take notes for you and collate an email after a client has done it and like make their jobs easier. But especially in working with like ultra high net worth clients in the wealth management space, the biggest thing that they tell us when they want to hand over their money and hand over the keys is, I need to trust you. Trust is the biggest element. And sometimes with a human, it takes them months and months to develop trust.
Yeah, you don't trust a robot. Yeah, you don't trust the AI that tells people the Nazis were African American. And I mean, look, I think this is really obvious stuff. But you know, there are some people working on solutions that are in search of a problem. Most people don't have a problem interacting with a human advisor. So making a robot one doesn't actually solve anything for anyone. It sounds great in a pitch deck. It definitely raises venture capital and angel money. And, maybe one will succeed, maybe two. But ultimately, most of the large-scale financial advisory firms in America will have AI built into every...
Yes.
This is the big thing. So we have human advisors, and they have entire days calendared with client meetings. And before every meeting they go, somebody's paying you a lot of money. You need to be prepared before you go into that meeting. Reducing the process of preparation, utilizing AI, like what happened in the last meeting? What are the highlights? Boom, right in front of you. That's way better done that way than having a kid 2 years out of college acting as a stenographer. To your point, then you have the meeting. The AI rides along. It's listening to everything that's happening. The meeting concludes. The client expects there to be follow-up. like an email. What did we talk about? What are we doing? What kind of accounts are we opening? Who's moving what money where? Are we missing a beneficiary? That work can be done by a paraplanner or a young advisor, or the AI tool can do that work, or some combination. The client doesn't really care operationally how it gets done. They just care that it gets done. So this is where we're headed in 2025. I think this will become like, we'll laugh that we were even talking about it in 2024. So yeah, I think the answer is, if you can be more efficient in how you help clients, you can obviously help more clients.
Right. So maybe we'll need fewer advisors because they'll be more efficient, but it's not like it's going to put advisors out of business. And also, my only advice to you leaving your kids home alone, before you leave for Mexico, watch Project X with them, just to plant some seeds.
Oh, we will not be doing that.
Do you think, on the AI note, do you think that there'll be some sort of attribution developed where if an advisor pulls from Ben and your blog, Josh, to help answer a question for a client, that's like tracked and you get some kind of credit for that?
Yes, I think every firm that does content is going to have a GPT where advisors might want to say, well, what would Ben Carlson say to this question? And the AI is customized to incorporate all of the wealth of common sense that Ben has contributed in his content over the years. I absolutely think a Ritholtz GPT is something that someone's going to come to us and say, we'll help you create this. It'll be built on top of ChatGPT. It's a custom layer that will surface answers for both advisors and clients from the million hours of podcasts that you guys have done and the 750,000 blog posts that have been written over the years. And we'll fine tune it, we'll test it, we'll refine it. But yeah, 100%. We've got a culture of investor education at this firm. Probably have done more of it than, I don't know, anyone on earth. So I think that's really exciting potential use for AI, to be able to delve into all of the stuff we've done and come up with insight.
Well, think about it. Our advisors, once a month, I'll get a ping from an advisor saying, hey, have you written about this before? Give me the old blog post you wrote about this. The ChatGPT will make it so I don't have to have it up here anymore.
100%. And it's I would say it's coming, but it's probably already here. It's just a question of how fast firms can implement these tools. But
and then once we have it,
get better every day.
Barry will argue with himself, hit the AI version of himself online all day.
Yes, Barry will have conversations with AI Barry from morning till night.
All right, let's do another question.
Okay, up next we have a question from Jeff. And it's raining really hard here, so I don't know if you can hear that. But if you hear that, that's what that is in the background.
I hear it, and it's very romantic.
Okay, good. That's what we're going for. Okay, so Jeff asks, I think investors are very excited with what Trump will bring to government: crypto, deregulation, and lower taxes. However, I think that will all come after tariffs and a brief shit show where the markets will drop. I'm thinking it's not a bad idea to take some gains after we hopefully get a Santa Claus rally. Then save some dry powder for a time after Trump puts in the tariffs and we get chaos in selling. I'm thinking he'll then normalize and we'll get the animal spirits going again with lower taxes, deregulation, and all the other things that come with our first libertarian government. Buy the election and sell the inauguration?
Are tariffs libertarian? I don't know how that.
No,
I didn't think so.
It's not our first libertarian.
Listen,
government.
I'm not a fan of investing based on cute sayings, and this whole question might be a little cute, but I think if you want to narrow it down, like, are we due for a correction at some point after the inauguration or whenever? Then I would say yes, probably. Doesn't mean it'll happen. I don't know, but yes, everyone is probably feeling a little too good about themselves as far as the markets go right now.
Yeah, there's a lot that could be said here that's like political, and we don't do that, and nobody wants to hear other people's political opinions that they don't already agree with. But I would just say, I talked to Professor Jeff Sonnenfeld on the compound earlier this week, and I asked him, why didn't the market have a bigger sell-off when Trump threw out that tariff salvo on Truth Social, which happened, I think it's already a week and a half ago. Futures fell because it happened at night, And then the next day, I think stocks started rallying again, because I think at this point where Wall Street has landed is this is like a relic of Trump's negotiation tactics from the New York real estate biz of the 1980s and 90s. You walk into the room, you punch the other guy in the nose, and then everything you say afterward sounds reasonable in comparison. So I think the street gets it. I'm not saying there aren't going to be tariffs. I'm not saying we're not going to have tariff-related sell-offs. Of course we are. We did in 2018. We will again. But Trump's scoreboard is the stock market. That's how he views his own. That's his report card. He's told us this a million times. So if he is starting to do things that are causing significant enough havoc in the real economy that the stock market is being affected, it's not like that's going to happen in a vacuum and there won't be a reaction in the administration. So I'm not telling you what will happen. I'm just telling you this is where Wall Street is as a consensus.
And it's also true that, like, the stock market will be the vigilante this time. If there are some ridiculous tariffs placed that are going to impact earnings, the stock market will move in a hurry and make. But I just think trying to time these things and say, well, I'm going to sell now and wait for I don't know. That just seems a little too cute for me.
It might work.
It could.
I never took a single.
It could definitely work if you do that. I don't know.
I never had a single economics class, so I literally don't know at all. But is there any way that tariffs aren't inflationary? That's the part that I just can't wrap my head around. Everyone's upset about inflation.
Some tariffs are inflationary. Some tariffs are demand destructive, which actually is disinflationary. Okay. And the two things could counteract each other so that it doesn't necessarily show up in PCE or in like PPI. But so let's take the farm example from 2018, because it's we have two examples from 2018 that are worth pointing out. One is steel, which we won't get into now, but the really obvious one is the steel tariffs against China resulted in a Chinese boycott of U.S. agricultural products, and areas near where Ben lives were acutely affected. And basically what ended up happening was it cost us $28 billion over the course of 2 years in subsidies back to farmers. There's no way we gained, quote unquote, gained $28 billion as a result of stopping Chinese from dumping steel here. So it was a net negative for the taxpayer. But when the Chinese stop buying soybeans, it hits economies locally, especially in the upper Midwest, really hard. And Trump can't ignore that demographic, because that's a big part of his voting base. And those are all swing states too. Wisconsin, Michigan, Ohio. Like, these people really are his base. So he knows it. He's not stupid. Like, you put your hand on a hot stove, and it burns you. You don't do it twice. So I don't think that
my son has actually
take the same form.
My son actually does it twice.
Anyway, I don't think we're gonna be at the same starting point. Now, that being said, Bob Lighthizer, who was the trade representative negotiating these things last time, his deputy is the new Lighthizer, and he's a psycho too. Peter Navarro is back in the mix. Peter Navarro has his 7 deadly sins of, like, what he perceives as being what China does wrong to us. Like, all of these people are back, and none of them feel as though we went far enough last time. So it's going to be a little bit of a minefield, and there are going to be some days where we wake up and the futures are down huge because something was posted on Truth Social. Just deal with it. Like, get used to it. This is the environment we're going into. The best thing that I could tell, last thing I want to say on this, one of the things I said during the pandemic, every day there was a new set of numbers from the CDC, from Cuomo, from Dr. Fauci, like the new death rate. It was crazy. And I said, the stats will continue to shock us, but they will shock us less each time. And then we'll start laughing about them. Like, you can't keep shocking the market with the same information over and over again before the market gets accustomed to it and starts to game it. So maybe the first 5 tariff announcements result in huge volatility, and then the next 5, I promise you, don't have anywhere near the same impact. Because one of the things that the investor class is really good at is getting accustomed to whatever the environment is, and that'll happen. And it might even happen in the first 3 months of the year.
Regardless of what Trump does, we've had 2 really good years in a row in the stock market, both up nearly 30%. Very little volatility. We had a 10% correction last year, an 8% correction this year. So, yeah, the stock market is probably going to be looking for some excuses to have volatility, regardless of the reason.
EH is saying Trump has no guardrails this time. We'll see. I agree that he's not going to listen to people who don't already say what he thinks, but
Stock market is the guardrail.
look, he put a lot of clowns into a lot of really key positions, and it's somewhat scary, but not a Treasury. And I think Scott Bessent will have his attention, and I think that his supporters will talk him out of throwing Scott Bessent out the window the first time they have a disagreement. I think from an economic and a financial standpoint, we have some really good people in the mix. But one of the things that we learned about Trump from the 50 books that were written about inside the Oval Office, he likes for his minions to have arguments in front of him, and then whoever did the best in the argument, like a TV show, that's whose opinion he goes with. He calls it a team of rivals, and he genuinely enjoys the theater of that. And if you make a really convincing argument against someone else inside of his administration, he's going to go with the person that he feels won that argument.
You know, I had a friend in college. I had a friend in college who tried out for The Real World. Remember that show? Before it got crazy? And that's basically what they did to try to get you on that show. They put 5 people at a table, and they'd say, everyone talk about abortion, go. And whoever was the best argument, they moved on to the next round because they wanted people who would argue. And
it's a good way to weed out the psychos, like the people that completely lose their mind.
Yes.
It's like, oh, well, we don't want that, or maybe we do.
All right, let's do another question.
Okay, up next we have a question from Jennifer. My husband and I are both 48 and make $125,000 a year between us. We have $165,000 in Roth, $65,000 in our 401ks, and then they note late start, but we maxed it out last year. And they have $275,000 in brokerage. We live in a very high cost of living area in California and have a 5-year-old daughter. We rent and hope to buy a house, but that seems unrealistic right now. My husband's parents are 82 and 77 and very open about finances, so we know that we'll be inheriting about $1 million when they pass away. They're in good health, but father time is undefeated. Is it okay to lower my husband's 401k to just get his company match? We still plan on maxing out the Roths, but this would allow us to save for a house and be able to do more fun things with our daughter. I don't want to miss out on the now by putting so much away for a future that might largely be taken care of.
I feel like
this is an interesting one.
Yeah, it is. The inheritance, this is like inheritance and housing, obviously. 2 big topics here. We've been talking a lot about inheritance lately. We've got a lot of questions, and it's not going to go away. UBS had this global wealth report this week that said $84 trillion to be passed down over the next 20, 25 years. I think another one in Bloomberg estimated at $105 trillion. It's a lot of money. Most of that is in the U.S. Now, like the easy answer here is just live your life and don't worry about saving as much because house is a financial asset. But I have the answer here. So this is very rare to have people who are that open about their finances, especially in the baby boomer class, right? Josh, would you agree with that?
Yes, I
People
would.
aren't. It's usually a taboo subject. So here's the deal: ask them for an early inheritance. Like, tell them, listen, I don't want the $1 million in 10 years or whatever. Give me something now so I can put a down payment on a house for your son and your grandchild. Do you think? And I think they probably wouldn't even realize how much you're struggling, and they'd go, "Oh, of course, yes, let's do that." If they're willing and open to talk about it, ask for the money ahead of time. Don't wait.
Could not agree more. And I am a beneficiary of that mentality. My wife's father is an accountant, and he worked his whole life. And the money is for taking care of himself and his wife during retirement and for his 2 daughters. I married one of them. And when we needed to buy a house in 2008, I was like maybe in the worst place in my career, and we needed some help. And he's just like, I'd rather see you guys in the house with my future grandkids. Like, what do I need to hold this in a Fidelity account for? And that help was really important to us. I don't know how I really could have done it without going insanely into debt, without a little bit of help. And look, we see our clients doing this for their adult children every day of the week. This is a huge part of what we do here, is helping boomers make these types of decisions for their Gen X and millennial children. It's like a really big part of the planning process. What we do, help them figure out the right way to do it, etc. So yeah, I think that's a good answer. Ben, I consulted with Jonathan Novi and Brian Rosen. I think you've had both of them on your show at some point, right?
Jonathan for sure.
Brian is a little nervous.
Brian is a little nervous with the cameras. Don't tell him I said that.
All right. Brian and Jonathan are certified financial planners at Ritholtz Wealth, based in Chicago, and they're also shareholders in the firm and two of the nicest guys I know. And I asked them, I sent this question to them, and here's what they said. Novi said, couple thoughts. Don't be afraid to live your life now and make the most of the time you have with your daughter. Sounds like you are already on board with this. Understand, however, everything is a trade-off. If good health is true, you might not see said inheritance for 20 plus years, and it could be that your in-laws live long enough where the $1 million isn't as much of a guarantee as you think. And if owning a home is non-negotiable, then dial back your 401k contributions and save more. A home is less a financial decision and more a family emotional one. And Rosen pretty much concurred. $1 million could evaporate pretty quickly if either or both of the parents end up in any kind of long-term care.
The 20-year thing
is
is
Dave Airy in the chat is asking about that. Long-term care costs. You don't know what they're going to be down the road.
Well,
that's true.
Nobody knows, and of course,
the robots
having more
will take
money
care
is
of
better than less.
The robots will take care of people at that point. But the 20-year thing is important because the UBS report also said the average age that someone gets an inheritance is like 59 or 60. And when is that money going to be better for you, in your 40s or your 60s? Of course, in your 40s it matters more.
Yeah, those are your peak. People say peak spending years. Those are your peak consumption years, is the way I think about it. You're raising your family and building a home. I don't mean building a house, but like having a house, but building it into a home. This is the whole ball game. You're going to spend the next 30 years thinking about all the memories that you've created, and it's the bedrock of your children's formative memories. So what are we doing here? Like holding ETFs instead?
Right. All right. Next question. This is a good one too.
Okay. Up next, we have one that came in via YouTube. I recently sold my condo for $400,000 and want to invest the money in the stock market. However, it appears the market is at an all-time high. Should I invest elsewhere or wait for a correction?
This is what crypto is for.
I think this one came in directly from YouTube last week in the comments. John, give me a chart on new all-time highs by year for the S&P. This year we're at 57 and counting. We're closing in on 2017 levels, but there's been a lot of all-time highs. I think I counted 300-ish in the last 10 years, which is pretty good.
Ben, on 57 days this year, people said, all right, not yet.
Yes. And that's the point. It's like we've had a lot of all-time highs. And the in the back of everyone's mind is, but the next one is going to be the last one for a while when I invest. It's the Murphy's Law thing. People expect things to go wrong when they put a big chunk of money to work. We launched
the RIA in September of 2013, and we had people say, I want to become a client, but I don't want to, will you hold my money in cash? No.
Right.
All right, well, I'll come back to you at a better time. And this is the market had made a new all-time record high in May of 2013 for the first time since October of 2007. So people were like, wait a minute, we just made a record high after 8 years. I can't invest now. When I tell you that the Dow was like 17,000,
right?
I don't even want to tell you where the NASDAQ was. So I get it. It always feels like you're about to be the guy that bought the top. It's completely understandable. So maybe, all right. Can we do this NASDAQ thing really quickly, and then I'll give my answer to what this person should do?
Yeah.
Okay. So today the NASDAQ hit 20,000 for the first time ever. And I have up in front of you guys a timeline. So it hit 1,000 in February of 1971. It doubled and hit 2,000 in July of 1998. It peaked at 5,000 in March of 2000. This is the nightmare scenario, by the way. This is what everyone's worried about. And then it took 17 years to get to 6,000 in April of 2017.
That's crazy.
So everyone thinks that they're about to put a giant lump sum into the market in March of 2000.
Yep.
And then have to wait 17 years to get their money back. And I understand that feeling because that would really suck shit. Notably, the milestones are happening faster now. We hit 19,000 for the first time on November 7th of this year, and here we are at 20. And we've doubled since the pandemic summer. So I understand like, oh man, I just sold my condo. I got 400 G's. If I turn it into $200,000, I'm going to feel like the biggest idiot in the world.
Yep.
If you just go by the data and you read Nick Majuli's book, Just Keep Buying, the mathematical answer is you just put it all in today and hope for the best. That's probably not the most emotionally satisfying answer, especially if a correction starts within a week of putting it in. So what I would do is a diversified portfolio. I would rely on the fixed income portion, probably underperforming for a while, but then saving your ass the first time the market falls big. You'll be able to rebalance. You will not have the bragging rights of saying I perfectly timed the market, because of course you will not have, but you'll have a plan in place of what you're going to do if and when the market has a severe pullback. I know you wanted a different answer, like wait till May 12th, but I'm just telling you the answer that we have been telling people for 11 years, and it's been helping people and working really, really well.
The diversified part is big. If you are thinking about the stock market and you can't handle worrying about that other side, then yeah, have some of it in fixed income, have some of it in cash, have some of it in stocks, and maybe some of it in whatever else you want to invest in, and have an asset allocation, and that might make you feel more comfortable and able to put it to work right away. When we have this conversation with clients, when they sell a business or they come to us with a pile of cash because they didn't invest, we always give them the math and the feelings. And the math is, look at Nick's numbers. 3 out of every 4 years, the stock market goes up. Most of the time it goes up. You're better off lump sum investing probability-wise. Emotionally, you'd probably be more comfortable dollar cost averaging. And almost always they choose the emotions, not the math, right? Some people take the math, but most people take the emotions.
It's okay if they do. We don't have enough information here.
So yeah.
You sold your condo, but where are you living? Was this a vacation property? Because if it was, maybe you buy another piece of real estate, and it's a 1031 exchange, and you don't worry about the taxes, and maybe you don't need this money in the market. Maybe there's another investment that you'd rather make if you just did well on this condo. We don't know if that. Where are you living now? We don't know if that's primary residence or not.
But yeah, if all-time highs spook you, maybe the stock market is not the best bet with all of your money.
Hey, if you don't like all-time highs, consider China. It's in a 50% correction. But I looked
at the average since 1950 over any 10-year period is like 170 all-time highs that you're going to get over any 10-year period. So there's going to be a lot of them. So we've had more than average the past 10 years. But all-time highs are nothing to be afraid of in the market. Yeah. One of them is going to be bad, but that's one of many.
James in the chat asked a question I was going to ask, which is, what's a 1031 exchange?
You sell a piece of property, you have a certain period of time where you can buy another one and defer the taxes from the sale. So This is how rich families in Manhattan have stayed rich through multiple generations. This is the Kushner playbook. At all times, they always own buildings, and they are not paying the gains when they're selling buildings because they're buying new ones. One of the things that we've done in the wealth management industry is we've taken a step further. We have opportunity zone funds, and this is like a wealth management firm probably has lots of clients each year that have just sold a piece of real estate. They can put the money into an opportunity zone fund, which will then invest in a blighted area of a city, and they can defer those taxes. And it's actually an even better break. The city gets what they want, development capital coming from wealthy people, doesn't matter what state they're in. The investor gets what they want, which is not to eat the tax bill just because they've sold something, and maybe a little bit of diversification. So this is why, if this affects you, you need to be working with a financial advisor.
Yeah, and a lot of real estate people are rich because they hold for the long term because they don't want to pay taxes. Buy and hold.
Yeah.
All right.
So
makes sense.
Rich people in real estate are their own breed.
Yeah.
And one of the one of the benefits of how illiquid their assets are is that they never sell. And then if and when they do sell, they immediately roll it right back into another property. You never see a real estate family take the money and throw it at the stock market. It's just not that does not happen, I promise you.
All right, we got one more.
Okay, last but not least, we have a question from Paris. Love the show. I'm a DIY investor that's mainly invested in index ETFs, but I allocate a small portion of my portfolio to long-dated options. I understand that this carries a fair amount of risk, so I keep the allocation to under 5%. However, I think these afford a sizable opportunity to supercharge gains in a portfolio. Why don't more people advocate for a small percentage invested in long-dated ATM? Is that at the money?
Yeah.
Options? Is it because most people don't want to manage the position?
I mean,
Yes.
most people probably don't understand how options work. Yes, but it's options. We've talked to a lot of ETF providers about options in the past, and it's not the kind of thing that you can just set it and forget it. Option prices change based on the market and the volatility levels. It is also funny that like long term in options just means more than a year, and usually these options are 1 to 2 years, maybe 1 to 3 years. So like long term is, I don't know. I'm not saying you're buying a lottery ticket here, but picking the winners of the next.
Well, it's
1 to
at
2
the
years.
money. It's at the money. It's almost like it's like a way to add juice to a trade that you already have on.
So that means
It
literally
sounds
buying,
like that's what.
buying a call for where a stock currently trades?
Yeah, you're betting on the upside of the stock, but you're putting up less money because you're buying the premium. You're buying the contract versus the stock. So like on a dollar for dollar basis, that's the leverage. That's like you're able to juice the returns on your own capital. I think Ben is right. I think most people are not looking for more complexity, even if it means more return. And I think for the average person who's trying to run a company, work in a job, have a life, the last thing they need is to have somebody turn over an hourglass on them every month and have this like ticking time bomb in their portfolio that they have to make a decision on
Right, now what are you
before
gonna
we
do
get
with
to
it?
expiration.
They're like
Right.
running to the bathroom at work to check their...
Are people looking for more things that force them to make a decision every third Friday of the month? Like I think most people are not looking for that, and that's probably why more people don't do it. It doesn't mean it's not a legitimate strategy. It's if you want to put the time in and do that, it's great.
And I like the fact that they keep it under 5% of the portfolio. So they're levering up, but they're doing so in a responsible manner against index ETF. So I think the way that they're doing this is going about it the right way.
Yeah. But listen, score-les-vous. by all means, keep going.
Yeah. Yeah, I wouldn't want to manage an options book. It's a lot of work.
I'm
Yeah,
more
I'd
of an
rather
iron condor person. You know?
Back to how we started the show. I'd rather manage a diamond mine.
You got to talk like a South African, though, Leo style. Okay. Thank you to Josh for coming on today. New Compound and Friends this week. How many
Yeah,
more
man.
for the year?
I don't even know who's on. Oh, I know who's on. Shh.
It's a good one.
All right.
This is a first-time guest. This is a big name.
Good.
How many for the year? 2 more. We're taping them both in the next couple of days, and it's going to be, as the kids say, lit AF.
Okay. I think we have 1 or 2 more Ask the Compounds coming. Remember, if you have a question for us, askthecompoundshow@gmail.com, or respond on Twitter, or leave it in the live chat, or on YouTube. You can get us any way you
Also,
want.
share your Spotify rap with us. We like seeing those.
And we have the Spotify video up now too, right? There's a lot of ways to watch us or listen to us. You can listen on
Hey,
Spotify or watch
guys,
us.
on behalf of the audience, can I thank the 2 of you? How many questions do you think you've answered this year? 500?
Probably a lot.
Oh, yeah.
That's 5
I mean, we do
questions a
five-
week,
five a show, yeah.
52 weeks. I'm not good at math, but I feel like you guys have answered hundreds and hundreds of questions for the viewers.
Yeah.
So I don't know if they're saying thank you, but on their behalf, I will say thank you guys for being here every week and bringing sanity to this world that we're in.
And we get a
you guys
ton
are
of
the
great
best.
questions because we have an awesome audience.
Of course, we
do.
love the audience. Thanks to the audience. Shout out to the audience too. All right, thank you guys.
Thanks, everyone.
I'm
See you
gonna
next
go take some more territory in Ukraine.
Oh,
All right.
God. See you, everyone.
All right.